Welcome to the Trading Pit, your virtual gathering for sophisticated traders. It's January 25th, and I'm asking, as we bounce back to nearly 40K, is the final capitulation wick off the table? I don't know. This is Marconi White, and today I'm joined by two of my favorite analysts, Mr. Watch the Dixie, JJ the janitor, and Ben, I'll talk rates with anyone who will listen, Lily, and they're going to break down Bitcoin's recent price action, where it goes next, and whether there's a trade worth exploring. I'm doubtful. Let's find out. I'm going to dive into the analysis with JJ, but first, I want to give a special shout out to CoinCall, who has offered to sponsor this video. And for those who are new to CoinCall, they offer a full suite of options, futures, and spot trading of your favorite crypto assets with competitive fees and a super elegant interface. And if you don't believe me, that's okay, because later on this show, JJ is going to show you what the interface actually looks like and how you can even play a Degen trade that he's sharing this week. You're not going to want to miss this. I don't want to miss this. I'm excited. All right, JJ, let's bring it up here. Last time I brought you on, you were so bearish. Made me want to hibernate for a week, a month, a year. I don't know. It was super bear. So tell me, where are we at right now?
Super bearish.
Yeah, as we look at the pre-market action, what does it look like right now? Bull, bear, more bear? Tell me.
Boring, but I don't think it's going to stay boring for long. So we're just consolidating around this 100-day moving average. You see this blue line here. We've just kind of found a short-term support here, it seems. And market's just trying to form a base and try to make a move back up to the yearly open, which is around 42,400. I still think that's in play, so long as this 100-day moving average holds. This looks like a pretty clear area where you could set a defined stop loss and look for that mean reversion bounce, but I don't expect it to last too long, to be perfectly honest with you here.
Now, why don't you expect this to last? What's weighing on your mind, sir?
The Dixie strength, to be quite honest with you. So even today's, this morning's GDP report, we saw it came in, it beat expectations, but so here it is. The expectations were 2%. It came in at 3.3, but previous was 4.9, right? So that's objectively not great. You have kind of declining growth. This should translate to a weaker Dixie, but the Dixie's stronger. So that's another news failure event where you have something that should move the market one way and doesn't cause a breakdown, right? You see it strengthening in light of that. That's something to be aware of.
Well, is it possible this is just a little bit of pre-action before we see a sell-off?
For sure. These pre-market hours are always kind of choppy and predatory, so we're really going to have to keep a close eye on things here into the open.
Okay. So from a spot level, we're seeing a bounce off the 100-day, but the Dixie's really weighing on your mind. And if that breaks north, you're expecting a pretty good sell-off.
Yeah, I think if it gets over 104, I mean, it's 103.60 or so is the 200, or 103.48 is the 200-day. So it kind of got a nice wick down, retested its 50-day moving average yesterday. And then it just bounced straight off there, and it's right back into range now. It's looking like it's kind of building momentum to finally break above that and get back into an uptrend here, pretty clearly defined. Until we really see this weekend, it's just hard to be long-term bullish on Bitcoin. So as long as Dixie's moving up in this consistent pattern, like you see, it's almost the same pattern forming here as we saw earlier in January, where it broke up, consolidated, broke up again. So it looks like we're seeing that play out now. And it could be aiming for a run above 104 here pretty shortly.
Well, I'm just going to say thanks for setting the tone for the show. 2 in a row. All right. So
we could still get that bounce though. Like that, as long as it's 100-day moving average, like I don't think you want to be directionally short just because of the amount of momentum that this could take up if we get some mean reversion to the monthly close. So I do still think that's on the table.
Okay.
I want to see how this market open and the rest of the day goes.
All right. So walk us through, is the market already digesting this data? Are you seeing it perhaps in the perps futures market? Are people starting to take positions expecting some of that price movement?
It seems like the perp futures have been getting increasingly short here. And let me open up our true interest chart.
Yeah, walk us through for anyone who's new here. Walk us through what this chart is exactly.
So the true open interest, we released an essay kind of describing what this is. This is a proprietary metric that Benjamin made about 2 months ago or so. And it's calculated by taking the change in open interest delta then multiplying it by Bitcoin's price at this time. And it basically gives you a more accurate representation of how much open interest is in the market, as opposed to measuring it in pure dollar amounts or BTC denominated. So if you look at, say, it's going to show you a different number, as opposed to if you looked at just traditional open interest, which if I look here on Coin Analyze, it is right now that's showing 10.5 billion in open interest. If we calculate the true open interest, it's actually showing us 2.43 billion. So quite a big difference there when you calculate it this way. And you can see the signals it gives us. So and for example, in October this year, when price started moving up, true open interest was going down. But if you were looking at open interest in BTC denominated terms or in just pure dollar amounts, it gave you the impression that open interest was going up as price was moving up. So we see October here, and it looked like this was ramping, right? But if you're actually calculating the change in open interest delta, it was declining. So this is kind of a good signal. And what this is showing me is price is going down, open interest is going up, is that there's a lot of shorts in there. And as Benjamin was saying 2 days ago, I think the people that are shorting now are much more sophisticated than the people we've been typically accustomed to seeing shorting. They're closing and opening up at advantageous spots. It's a much more mature participant that's been shorting here. So not necessarily your IBIT apes that are going to be easy to please.
The IBIT apes.
Yeah. And we can see this in funding too, in that basically since early January, the funding rates just declined despite this open interest going up. So let's look at the 1 month. So you see open interest was really overheated here, and now it's just been persistently down despite open interest levels climbing. So that's a pretty good signal that it's a lot of short open interest in here. And that's a reason why we could see kind of a short-term squeeze up there, just see how, if they actually want to hold these positions, if price starts to get momentum, or if they're liable to get squeezed out. I'm sure some of this is less sophisticated short, so there's definitely room for squeezing there. It's just a matter of whether the market makers want to take it or not.
Well, and this is a topic we were talking about offline, sort of the change in dynamics of the market. There's questions like how are the ETFs performing? How is the BlackRock ETF performing? We talked last Tuesday about how participants are becoming more sophisticated. So these are things that we have to study over time. They don't necessarily show themselves 1 week and it's all changed. It's not a flipping of a switch. It's rather you start to see those flows start to change, right?
Exactly. Yeah. The market's changed entirely. Like the people that are painting the charts and whatnot, it's different participants than we're used to. So there's definitely going to be a learning curve here in the months to come.
So if we could bring back the true OI, if I got the name for that right, can you just walk us through it? The question was, are we starting to see anything in the chart that would tell us that the market's positioning for a stronger dollar? Is there anything here? We talked about spot bouncing off the 100-day. What about here? I know you mentioned the longer term trend, but is there anything initial that you're looking at?
Well, if we look at since January 5th, true OI was around 1.93 billion. And now we see it's up above 2.43 billion. So that's a gain of almost, $500 million as open short positions. And it seems like Bitfinex longs are offsetting this. So if I look at BTC longs on here.
And JJ, real quick, I'm going to jump in, just add a little color, if you will, for why do we see OI rise when price starts to go down versus why doesn't OI start to rise when price rises?
There's just that dynamic of for every open long position, there's an open short position and vice versa. It's a zero-sum game, right? So when OI goes up, there's naturally going to be more short interest in it. And you can really see this clearly here is that when we were running strong in early 2021, true OI actually went negative 142 billion, right? So spot was driving the price for the most part here. It wasn't here. You see that as OI rises, it kind of suppresses price. So we see it was at its highest actually right around the FTX collapse, almost 4.3 billion, and price was suppressed pretty low. So it has this like weighing effect on price there. Does that make sense?
Yeah, definitely. And then of course in June 2021, like you could see that there was some positioning for a lower move in the market. A lot of those shorts got caught off sides. That provided fuel for the price to kind of return to that all-time high, where on the prior run-up in early 2021, that was mostly spot driven.
Yep.
And you can see that in the OI, something that I don't believe it really shows itself that well in the traditional form of US dollar denominated OI. And so right now you have OI on a longer term horizon showing it's declining, which is a healthy market. And while we're saying that OI is rising if you zoom out a bit, this is very healthy in the earlier stage of a bull run. But for right now, it is rising on a shorter time horizon.
Yeah, like we see since August, like the first run up this summer, there was a lot of open interest, and then that all got annihilated on the wick down from 29,000 or so down to 24,000. And then a lot of shorts entered. They all got squeezed out in October. And you just see the OI has been steadily declining, but it has been rising since January. So it shows that there are some shorts in the system. At what point they get squeezed out, like we could see this realistically return back to 3 billion if Bitcoin continues to decline here.
So I want to ask
keep bringing this up because it's definitely a good chart to watch.
Absolutely.
You can see the pattern here, right? Like where price ascends, OI goes down, OI goes up, price declines. So right now it looks like that's changing back. We had a few months of OI declining. Now it looks like it's on the rise again. And price is most likely going to keep working its way down so long as this is rising.
Well, JJ, you often talk about looking to hunt longs or hunt shorts as a way to move price, not necessarily out of range. We talked about that. I think Ben, many episodes ago, talked about the spot volume being the catalyst for that. But do you see anything here where people are starting to pile in? Based on what you just said, there's been a steady accumulation, but I'm not actually seeing anything that people are jumping right now. It seems like everyone's a little bit hesitant.
If people were piling in, I think we would see this go negative. We would see negative funding, right? And right now it's just kind of at a standstill. It's basically neutral. It's not excessively bearish or excessively bullish. So it just seems like basically a healthy derivatives market.
Okay. All right. So right now we did have a bounce off the 100. We're not seeing anything from a perps perspective that's going to suggest that a bunch of people are piling in one direction or another. And the Dixie is still that risk that's sitting on your mind. I know we'll get to options in a moment. Ben, what about you? From your perspective, is there anything here that hasn't been brought up that you think, I don't know, suggests a different story by chance? Any counter narrative that you want to share? And if it has to do with interest rates, we'll get there. I promise.
I really don't have too much of a differing opinion, unfortunately. I kind of wish I did so that we could have a good discussion on that front, but I don't. I mean, it's really, I guess the main color I would add is really a couple points here, which the first one is, our CARI model, which helps us understand if volatility is incoming. And I have it pulled up here, and these blue dots represent when that model does begin to show signs that, hey, it's time to pay attention in the market. And if we zoom in, we've had constant readings of late. And with that knowledge, if I pull up one of my more favorite charts to look at from day to day to understand how the options market is pricing in expected volatility, which is implied volatility, with the understanding that this CARI model is flashing signs that volatility is incoming and it's coming in at a very high clip, that reading, and we look at how much the market is pricing in, whether price will start to whipsaw around or not, we see that it isn't. And so to me, that showcases like there's a little bit of a mismatch in the market right now. There's starting to be signs and signals that price is going to start whipping around up and down, or perhaps we're going to get that liquidation event. I think that Benjamin talked about on the last show. Like we haven't really seen that cascading liquidation, that capitulation type of wick, not like a lower low type of capitulation. That doesn't have to happen in the early stages of a bull market. It just, you need to have some people caught off sides that generates good liquidity, and that really creates the fuel to make another leg higher in the market. And a lot of times that just takes time in general. And when we think about who would be that fuel, I think it's going to be basically anybody that's trying to suppress implied volatility. When does this actually happen? I made a post, I forget when, I must have been Friday, where I asked, is implied volatility going to be higher or lower? And I did that because price was dropping, and you could sense the fear in the market starting to show up. With that additional fear in the market, you would expect implied volatility to start to rise at a good clip, and it did over the weekend. But the rate at which that got brought back down, I thought it was going to be on Monday. It ended up being, I think, late on Tuesday, Wednesday. Pricing returned back to what it was prior to that sell-off. It's like, okay, somebody's really just getting a bit stubborn when it comes to this selling implied volatility. Okay. And that stubbornness is going to get hit. Right. So right now, I pulled this chart up just to really kind of showcase it a little bit more. This dark blue was implied volatility for at the money for each expiration date, those contracts. And so you can see what that rating is. The higher the rating is, the higher the expectation of more price volatility in the market. The lower the reading, the assumption that we're kind of in this sideways market or like a steady climb in price. The light blue is, I believe it's today. Yeah, it's today and it's lower. Okay, so if based upon all the fear in the market, I would not expect to see this chart right now. I would expect to see it flipped or at least just a good bit of premium on the the light blue line. And we don't see that. So to add a little bit of color to what JJ's talking about, I think there needs to be a little bit of a changing. We mentioned this months before. It was a similar concept, a change in regime when it came to selling volatility. I think that's what's going to get hit when we look at what will be the fuel to keep it going in reverse higher.
Yeah, you look at this, options are basically the cheapest they've been since that gamma squeeze in October when Bitcoin ran up from like 28,000 to 35,000 in a day, basically. Since the ETF, here's the ETF launch. Implied volatility was at a score of around 77, and now you see it's just falling off the cliff here. And people just seem eager to sell premiums at basically any price. I don't know what your upside, like your risk reward selling implied volatility here doesn't seem great to me, but
in that time frame, I believe we were saying the same thing. It was just, hey, it's time to have this regime kind of get blown out here, and it did. We ended up seeing it shortly after, and I would think it's going to happen again.
And if you look at realized volatility, so if you look at the BVOL chart here, look how long this has been suppressed. Like you basically had since June 2022, you could sell premiums on any bounce and make a good bit of money. But now it seems like this is going to be due for reversal here, whether that comes next week, next month. At some point, that seems it's coming, right? Like you look at this chart, it looks like it's pretty ready to ascend. So this is the amount of realized volatility, and this is how much volatility is the market's expecting. So there's a clear divergence there between how much volatility we're actually realizing and how much the market's pricing in. And it does seem at some point in the near future here, people are going to get caught off sides again in a big way.
I want to explore
being
this.
a premium seller, right? Like you think, okay, I'm going to sell a put option for $150 and it expires next week. If it expires worthless, I make $150. But if Bitcoin crashes to $20,000, you lose, massive amounts of premium. You're sitting on huge losses. The risk reward just seems extremely skewed to the downside. Like I could understand it the week of the ETF when we had that massive run up and it was overheated. Like this is a good spot to sell volatility, obviously, right? But when it's down here, I mean, typically the people who are selling volatility are much smarter than me. So take that for what it's worth, right? Information I don't have, and they're suppressing price in one way or the other, and they're just collecting risk-free premium. But to my layman view here, I think it's a very terrible risk-reward proposition.
Well, I do want to explore this because I know we're going to be talking a little bit about this potential liquidity Armageddon event that could be happening that Ben's going to chime us into. And then JJ, I want to talk a little bit about if we look at the vol and how people could potentially position themselves. I do want to get into that, but before we do, the markets have now opened. We were talking about pre-market. I'm curious whether or not the markets, JJ, have started to digest any of the information we were talking about. Well, walk us through at least if where Bitcoin is moving right now, maybe some of the beta stocks as well related to Bitcoin, just to see how the market's digesting this information.
Nothing major here. It seems Dixie's actually moving up upon the open. Miners, so you see Mara's catching a nice bid, so that could be a good leading signal. It's up 2.3%, despite the fact that Bitcoin's down a fraction of a percent here. So maybe we do start to see that move back up to 42K in the coming days here. I think it depends on how Dixie does. It's approaching the 200-day moving average. If it's going to reject from there, make lower lows, return back below 103, I think that's basically your signal that we're going to get that move up to the yearly open around 42,400. But if Dixie charges over 103, is it 103? 103.49 is the 200-day moving average. So I think if we see Dixie start to trend above that, that's your risk off signal. And we're probably heading to lows lower than we were at on Tuesday, which is around 38.4. So I still think that 100-day move, like if you wanted to enter along here, I think that's a good risk reward. Basically use that 100-day moving average as your stop loss. And I think you have a pretty clear take profit signal around the 50-day moving average.
Okay. I want to ask here, because we've had a lot of participants join us who are going to they have questions about the miners. They're looking at some of the beta stocks. We had a question about Coin last week. We had a question about these stocks. I want to ask, I haven't seen the sell-off there, right? We've seen Bitcoin obviously pare back losses, but with those, this seems like they seem to not have really reacted yet. So I want you to kind of explore that and give a perspective there. Before we do, if you're new to the stream, you haven't already, hit the like button, hit the thumbs up button, just so let us know that you're out there, that you're enjoying the stream. And if you got questions, definitely drop them. We'll see what we can answer. But JJ, why don't you let us know, do you think that they're just waiting to have a bigger correction? Are they starting to diverge a little bit, which some people have thought may happen as the ETFs come online?
I think they're waiting to see what Bitcoin does. So while Bitcoin's in a range, they chop around. So, you'll see 3 to 5% moves in either direction for things like Mara and MicroStrategy, et cetera, when Bitcoin's just moving in a confined range. But I would say if Bitcoin does break above the yearly open and the 50-day moving average starts to trend up, you'll see these outpace in a big way. And likewise, if Bitcoin breaks down below the 100-day moving average around 39,000, you'll see the sell-off continue in these. It's just beta. Like that's all there is to it, is that they just overreact to Bitcoin's moves. So one way or the other, when it's in chop zone, they chop as well. It's really hard to find a pattern in them when Bitcoin's just moving in a confined range. When you really want to play them is when you have a firm belief that Bitcoin's going to move out of the range in one direction or the other.
Right. Well, it's either at the top or the bottom.
So like Bitcoin gets to 44,000. You could probably see Mara back above 20 in that scenario. MicroStrategy probably above 520 to 560 in that range. So they're shaping up for big moves if Bitcoin does make that move back above the yearly open, but nothing like definitive to where I'd be like, oh, you have to buy it now, right?
Yeah, it's buying.
You can see the chart patterns look similar. So MicroStrategy as well is consolidating on the 100-day moving average here, same way Bitcoin is. They're very similar in the way their charts look, which I don't think is a coincidence.
It's interesting. I mean, I'm curious what you think here, JJ, on those miners relative to Bitcoin, of how those miners almost front ran the sell off on Bitcoin and post ETF.
Yeah, look at that. There was a clear top in December, and that's kind of why I look at it. When you start to see them show strength before Bitcoin does, that could be a good leading signal. Like if you see these make a 10% move and Bitcoin's only up 1%, that might be a good idea that we're going to get a larger run in Bitcoin. So they can be used as a leading indicator in some instances. But yeah,
it looks like at the start of the year, that's kind of what happened. Most of these miners started to run hot before Bitcoin.
That was the trade that we were on from $8 when we were asking the pre-ETF trades. But you have to understand what these are. Like they're essentially meme stocks, junk stocks, whatever you want to call it. In that when their stock price gets too overheated, like it does here, they'll issue more shares, they'll sell their own shares because their margins are so thin that they have to raise capital to keep the operation going. And the capital they raise is ultimately exit liquidity from retail participants that chase it. So when something moves from $8 to $30, you don't want to be the person buying at $30 because they're going to dump on you.
Yeah, that's how they raise capital. A lot of people don't
the business
tend to
model.
realize that. Yeah, it's, when you can issue and mint more shares and sell it to the public because there's so much demand according to what the price is. Right? Yep. That's what they do, and they raise capital and they can continue their operations. So
the beauty of that is that it does lead to overextended moves to the downside, which are easy to play for mean reversion when Bitcoin's going to break. So like when we saw these below $10, it was pretty obvious long signal. Like you saw Bitcoin was running up above 35,000. Mara was still below 10, right? So that was obviously a discrepancy in the market, and it was only a matter of time before these things moved higher. So that's a pretty clear long signal. When you see that divergence, when these are still beaten down and Bitcoin's in a clear uptrend, you can ride them up. I don't think now is the time. Like this is a pretty, even if it moves up to 20, I don't see this as a buy anytime soon. You want to wait for it to get back to those beaten down levels, see Bitcoin gain some momentum, and then look to enter it. There's times to play it. You just have to be extremely strategic and when you're in and out of them.
So I see on this chart,
go down.
Yeah, for the volatility to go down. I see on this chart we have IBIT, the BlackRock ETF, Bitcoin ETF. I know there's been questions from people asking, what is the performance to date, and what help them out, help answer that question. Is it too early to give any kind of reasonable information on that? Is there something that you would look at this chart, which obviously there isn't a lot of price information, but how would you respond to that question if someone's asking, what's the performance already of these ETFs?
It's just too early to say. I think we really need 6 months to a year to see how this plays out. I don't think it's going to continue to be down only for an entire year. That would be major reputational risk for people like BlackRock and whatnot. Like you saw Larry Fink going on every program imaginable, basically talking like Michael Saylor, essentially. You don't really notice too much difference in their talking points. So I don't think it's just going to continue to go down forever. At some point, it'll probably bounce and mean revert, and we'll see Bitcoin go on a run, but that could take a while, right? Like you see it in even these spot order books, is that they're still waiting to get fully filled on these ETFs. So they're going to be happy to buy the lower price goes. They're not in a rush to buy. They're not in a rush to sell. They're just happy to accumulate. And it's going to take a while for all the flows to go into these ETFs, I think, before we really see what the true market demand for it ends up being. And it's going to take a while. And these people are patient, their time frames are much longer than ours are. But realistically, the people that are buying into ETFs with major amounts of money, they're not looking to buy and sell over the course of a couple months. They're looking in terms of 6 months, a year, 2 years, etc.
It's usually right around that December time frame when bonus season comes along. That's their time frame.
Well, I was going to say, Ben, you've spoken about this several times on this podcast about just the amount of time needed for the infrastructure to be built for those inflows. So, looking at the performance today, this is just existing infrastructure. We don't have other funds that have gotten the approval to put any fund or to be buying these ETFs.
This is why a lot of people thought this was a sell the news event, is because the true demand for all these ETFs were not going to show up on day one. It's going to take a few months. I think gold, we said it was about a year before it returned to its price when the ETF hit the market. I think now, many years later, that speed is going to be quicker. And so it's not going to take a year. I think it's just going to be better timed up with the halving. And so we have that coming at the end of April here. That seems like it's plenty of time for some of the piping to be set up, some of the future demand to be queued up, and for maybe end of Q2 for that to really start to ramp up, and into Q3. I think at some point we're just going to see Coinbase Premium start to skyrocket. That to me is just, if that becomes nice and thick and juicy, essentially, to use very descriptive terms there, don't second guess it. That's what it is, and just run with it and go ahead and get ready just to ride the wave.
Right now we see a misbalance of supply and demand. We had massive amounts of supply come in, and there's a decent amount of demand, you see it, but it's lower. It's at lower prices, like these bid walls. They're not stepping into market buy, right? And you have a lot of selling pressure at the current market price due to the grayscale unlocks and whatnot. And imagine if we do get a wick down to, say, the 200-day moving average, or even below 28,000. You would have so many people capitulate there on top of the grayscale unlocks that the amount of supply of it, if you're not going to sell below the 200-day moving average, you're probably not going to sell ever. You just have people that are content to hold regardless of price. And then at that point, we passed through the halving. The daily supply from miners isn't coming in anymore. And I would imagine we'll still see that demand that's showing now for these ETFs and people looking to make long-term allocations to Bitcoin continue. and then the supply demand dynamic is going to shift in favor of buyers. And that's really when we'll see the big move. It's probably going to come after the halving in all likelihood, or possibly they front run it by a month or so. But it's going to be a while for the market to digest the current amount of supply that's coming in, and then it's going to be a one-way street the opposite way. So have that in mind.
I'll also add, I just pulled up the spread between Coinbase and Binance, and then overlaid Bitcoin's price. And if we were to go ahead and kind of see when that spread returned back to neutral,
walk us through the spaghetti. Yeah, what do we see here? What are the different waves?
Yeah, let me just reduce some of the noise here on the chart. But yeah, you can kind of see the spread returning back to neutral here, right around 0, and you kind of see this flatlining in price. And for those that sold volatility, this would have been a nice opportunity, probably similar to what we're seeing here. We're returning back to 0. It wasn't the first time. We had it happen over here with a bit of a sideways crawl market before we kind of ramped it back up. I mean, this point right here, I believe anybody that remembers this time span, like this was a little bit of an uncertain time period. I think right in here, we were getting news about BlackRock. I don't remember if it was Cointelegraph or not, but this was some false euphoria before we ended up having kind of like that true euphoria into the ETF. But
yep, that was when they first released, when they first filed for the ETF, and the market had that run up from like 24 to 30 over the summer.
Mm-hmm. But you see, the market wasn't ready though. Like it was almost too soon. Like took people off, caught people by surprise, and it wasn't until the market was ready for another leg higher that it went ahead and did it with authority.
Yep. You could basically see it here. So Bitcoin looked like it was going to break down, fall to the 200-day moving average, and then BlackRock stepped in and saved the day, middle of June. And then we just made that, basically went up from 24 to 30 in about a week. And it just got way ahead of itself. And then it took that consolidation period. I think here's where we are. We're somewhere in this consolidation period, similar to August to October. So we probably have like another 2 months of just this boring back and forth chop, maybe a low volatility or a high volatility drop like we saw here, some high volatility bounce backs. But for the most part, it's probably going to be crabby price action through the halving.
Yeah. And for the chartists out there, this is like prime period for inverse head and shoulders to start showing up and getting painted. So left shoulder would be painting here in the next few weeks. And then you would get the move for the head. So that would be the capitulation move, and then start to track it higher and out of that valley for the next leg higher.
That's coming.
Okay. So it's actually a pretty bullish picture for the longer term, and these could actually be some pretty good prices to pick up some more spot. But okay, so I want to summarize where we are, because I do want to get into this liquidation Armageddon liquidation event we talked about offline, see if there's something there. And then obviously we're going to get into some more trades at the end of the show before we wrap up. But spot bounced off the 100-day. Perps, as we're looking, aren't really giving us any kind of, we've got suppressed volatility across the board. We're not really seeing any signals there. People aren't necessarily piling in. We're seeing steady accumulation. But of course, the real risk right now is Dixie, which continues to show strength. So I think right now the messaging continues to be, this is a careful time. Be aware of that, and jumping into any trade is going to be something that's, the risk reward is not necessarily going to be on your side. But I want to get into the next question, Ben, for you. As I mentioned, we talked offline about this potential Liquidity Armageddon event having to do with the reverse repo and maybe some changes that are going to come down the pipe that would impact the amount of liquidity available even overnight. The audience, what that might mean?
Yeah, that's, man, you painted a very scary picture, and I don't see why not, to be honest, because it's a bit uncertainty coming up. I think I mentioned this last week. I like to watch the Federal Reserve members and even international bodies and central bankers discuss, what they see in the market, and they always publish their speeches. And if you take the time to read them, they like to basically tell you when something's coming. And right now, so this is before the FOMC, I don't know if Jerome's going to talk about it. next week when that meeting comes due, but doesn't matter because this is what they're discussing and they're even saying it publicly. Jerome probably won't mention it because he doesn't want to spook the markets, and everybody's taking a look at reverse repo and that getting drained. And this speech, let me see who it's from because I kind of forget. But from the Federal Reserve Bank of New York, John Williams, president and I guess CEO of, I didn't know they had a CEO to be honest, but there he is. And I'm just going to read it because this is his words. And we can interpret it after the fact. But he's saying that the FOMC said that to ensure a smooth transition, it intends to slow and then stop the decline in the size of the balance sheet when reserve balances are somewhat above the level it judges to be consistent with ample reserves. So far, we don't seem to be close to that point. The decline in security holdings has been absorbed almost entirely by a drop in the reverse repo market. Now, that's that chart that everybody's watching day in and day out to see it get drained, right? And they're just stating it clear as day that their QT, so them unwinding their balance sheet, is being completely absorbed by the reverse repo market. Okay, so continuing on here. As a result, aggregate reserve balances are little changed from their levels in mid-2022 when balance sheet reduction began. Looking ahead to this year, as the balance sheet continues to shrink and usage of the reverse repo facility continues to decline, we will closely monitor money market conditions and the demand for reserves, which to me, and this is now my opinion, they're getting ready to test the market. And I don't think it's going to end very well. I think the market's going to be a little bit upset that their addiction, they're going to be feeling it.
So Ben, there's a lot there to digest. For those who aren't fluent in economic speak, can you just give us a 1-2 sentence of what exactly that they're hinting at?
So they're saying that they're unloading their balance sheet. So they have a bunch of assets that they need to unload into the market. And they've been unloading it and it's been offset. They're basically taking it out of the right pocket and then paying it with the left pocket. And so there's no change in true money in the market because it's being offset by all the money sitting in this reverse repo market. Security comes off the balance sheet, it gets purchased up by this other facility. Nothing's really changing essentially in the market. And this was the Fed's plan in order to create that soft landing conditions. They basically created this reserve of all this money that they knew would go ahead and act as like a buffer when they went ahead and did what they're doing, kind of rolling off the balance sheet as they call it, QT. It's getting ready to be dry. It's coming to a close. I fully anticipated that they would want to do I don't want to get too far into this because I haven't done enough research, but change the capital requirements to create more liquidity. But it looks like they want to go ahead and test the market's resilience here. And they want to see if it can withstand, essentially another uptick in QT. And with the Fed, it looks like the market is starting to price no change of rates here next week. Right. So you're going to have essentially rates remain elevated. And between this FOMC meeting and the next one, the Fed's going to want to test market liquidity conditions. And I don't think it's going to go that well. I think they're going to have to go ahead and step in. And I fully anticipate that they do have a plan in place.
So, how does the saying go? You can't taper a Ponzi.
Our wordsmith, our resident wordsmith, JJ the janitor, coming in.
Look at the RRP, right? Like it was almost $2.5 trillion in March. And then we obviously know what happened, SVB. And they had to basically unlock that liquidity, and now it's running dry. So what happens? And I think that might be what Dixie's warning us about.
Well,
they say that liquidity is going away, and as we know,
let's talk about specific signals you would expect to see, because we talked about things breaking. It's been a while since we've had TD on the show, but he was always looking at commercial market paper, the real estate market, retail credit, sort of various places where you could see cracks. And so you would see spikes in, for example, any kind of corporate bonds. So Ben, what do you think if they execute this plan, which is really the continuation of quantitative tightening, which I think they've been on for several years now, right?
Mhm.
If they execute this, is that where you're looking to see that breakage? JJ may be looking at the Dixie. Are you looking at the Dixie? Are you looking somewhere else to really say, okay, it broke. Now let's see what the response is.
Yeah. So the chart that I got here, the green, this is the amount held by the Fed. And then if you subtract out this repo facility we were talking about from that balance sheet, that's this orange line. So as soon as these two converge, the repo facility is dry. So as
Ben,
it
when you
starts
say amount held by the Fed, these are securities. What amount are we talking about specifically?
Yeah, so they'll hold securities, they'll hold treasuries. Predominantly, they'll hold cash for the treasury as well. If they have mortgage-backed securities on their balance sheet, it'll be reflected there as well. So these are securities that they're holding because the market they don't think can actually absorb it. So this is them stepping in to help out. And so as this essentially dry powder ends and approaches this green line here, this is basically that moment where like a kid would now have to go try riding a bike without training wheels. What's going to happen? It's it's gonna get battered and bruised, right? The market, and so that's what I think is going to happen. Now to warning signs, which you kind of alluded to earlier, and JJ mentioned the DXY, the US dollar index. I would expect it to show up over there, and I think the one area of concern that I have, let me readjust the chart I'm looking at to put up the 30-year, because I mentioned before that the 30-year yields and the dollar have a lot of similarities in their movements. And if liquidity starts to dry up because the Fed wants to go ahead and test it out, where's the spike going to show up? I think it shows up right here on the yields for 30-year treasuries. Like, I think the market demand isn't going to quite be there. And so these things are going to spike. And I don't anticipate them hitting a new high, but I would expect a bit of a move, like an abrupt move, kind of high velocity type of movement. And the market gets spooked. That's where I think it's going to rear its head.
Okay. So spooked, we can be looking at the 30-year. We see a spike there, and then we can talk a little bit about what we may expect from a market response. JJ, I think I know your answer, but is there anything that you're looking at, or is it purely you're going to be looking at the Dixie, and to really note that?
I think Dixie is your purest form of signal because ultimately, like if you're familiar with Santiago Capital's dollar milkshake theory, basically the amount of debt there is in the world, there isn't enough dollars to service it, right? So as things start to break, people need to raise dollars. When they raise dollars, obviously that drives up Dixie. So when we start to see Dixie move up, that's what's warning you, is that there's a sudden demand for dollars because people can't meet their debt obligations. So they have to sell assets, move into dollars, and you'll see Dixie start to move up. Like, it's pretty clear. Like you see here, this is basically the day the gilt market broke in the UK. Like you see these tops reliably. Here we see COVID, right? Obviously there was a extreme shortage of dollars in the system then. You saw a large spike in Dixie. You can basically see these events predictably based on how Dixie moves. And that's why I think it's such a powerful signal. Is I'm not smart enough to track things like credit spreads and whatnot, but I can look at this and see, okay, it's moving up. That's warning me. And that's kind of all I need to know.
That is your purest sign, because the market, it's going to need dollars.
Mm-hmm.
If there's a liquidity shortage in a certain market, it just means there's not enough dollars in the system, and basically the price per dollar is rising because there's a bit of scarcity taking place, and that's where it would show up. And it's not like, I mentioned the Fed likely has a plan. I mean, if you again go to these sites, they're already talking about, I think they call it like all-in-all clearing for the treasury markets. They fully anticipate having to add additional players into this market to help overcome some of the issues that are going to show up here. I have to imagine in the next month.
Ben,
This
have
is when
they?
it happens.
I saw a headline there about them changing the sort of the clearinghouse for treasuries. When you talk about them adding additional players, right now the primary participants are large U.S. banks.
hmm
Do we have any idea who those other players would be, and if they bring on other players, how that might impact liquidity and markets at large, specifically crypto?
Yeah, I think they're just trying to like almost distribute the market and allow more players to trade with one another versus having to go through a designated set of parties. And so they're
Mm,
really just opening it up.
okay.
Okay. Almost like, yes, you almost have to always go through a broker to buy equities or something. And then you look at crypto, and now you can essentially do peer to peer trading. Okay. So you can almost look at what the treasury market is doing. It's almost doing its first little step towards adding more participants into that market. I mean, here's the Federal Reserve Bank of New York. This is their front page. Am I sharing it? No, I'm not sharing this tab. Okay, they're highlighting. It's called the teller window, which is the future of the Treasury cash market in focus. This conference happened months ago. And
Yeah.
now they're just adding some commentary. Oh, these are some of the insights from this conference that happened 3-4 months ago. You should take note. They're just telling you. Just pay attention. That's all we need to do. And so that's where they all kind of describe it. And to even go one layer further, back in Jackson Hole, I think it was in August in that symposium where everybody's like tuning into what Jerome has to say, Jerome Powell, and then it's kind of like he does a nothing burger. Well, all those papers that show up, that's where all those insights are shown, and this is what they discussed: the changing landscape of the treasury market. And so this conversation has been happening for half a year, and they're just gearing up for it. Yeah, they want to test it. They want to test it so they can go ahead and see something and fix it. Okay, we should all just be aware. And if we want to go back to the Bitcoin price action and the timing of everything, give me that capitulation wick, time it up with one of these events, and I think you got it.
Well, I do have a question coming directly from our chat group from the Dirty Hammer. That's a name. How might this play out? And I'm going to ask the question, then I want to say a few things before you answer. But it says, how might this play out if the RRP drains around the same time as the halving? So I want to get your perspective on that question. Then I want to talk a little bit more about different positioning as we start talking about trades. But before we do that, we've had a lot of people, folks just like you listening right now, asking, how can you support this show? What exactly can you do to go above and beyond? Well, I'll tell you, it's really, really quite simple. You can hit the like and subscribe button. You can hit the notification bell so you're aware every single time we have the show, although we're doing it every single Tuesday and Thursday at 8:15 Eastern. So we're here consistently. You can share the show wherever you talk about crypto, your text change, your Telegram change, your Discord, your Reddits, X, wherever it is that you want to talk crypto. Share the show with other people, the other sophisticated traders that want to be in the know. And of course, if you're looking to go even further, you've got your coin call option, which is to start trading these options and futures and perps, whatever. And for those who don't know about coin call, they offer a full suite of options, futures, and spot trading of your favorite crypto assets with competitive fees and elegant interface. And again, you're going to see a little bit of that interface a little bit later in the show. But those are all ways you can support the show. We appreciate it. And we're obviously trying to get to as many people as possible to grow this. We've got grand plans to bring us all into the community and do some really cool stuff, which we'll be highlighting in the months to come. But those are the ways you can support us today. But okay, let's get back to the question that was asked by Dirty Hammer. Again, it was, how might all this play out if the RRP drains around the same time as the halving?
Oof. So the halving, that I think it's like the 22nd of April.
Mm-hmm.
And if we look at the upcoming meetings for FOMC, we got March and we got May. So halving is right in between the two. That 3 months right there, March, April, May, those are pretty ripe. Would it happen after the halving? I don't think so. Like if we're looking at how Bitcoin's painting its chart, I have to imagine it's going to be closer to March, that March timeframe. That press conference might be a great time to address this change in the treasury markets and alongside Yellen. So we'll see it, I think, happen before the halving.
And do we expect this to be an overnight change? Like if they announce that they're going to start with this centralized auction or rather distributed auction, they're allowing the RRP to go to 0. We're going to float it. Is it really going to be, we're going to see that change the next day? The next auction
they do
period?
make changes like pretty quickly. Like I think on SVP, the Silicon Valley Bank, they went ahead and did the BTFP program on a Sunday, I believe. So they stepped in pretty quickly and they implemented it. Like that program is set to expire. I believe they've even made mention they fully intend to let it expire. They won't renew it. So that period is up in March. And so those timings are lining up.
Okay.
Yeah, that's another hit to liquidity. What's worrisome too is you don't see legacy markets prepared for a liquidity shock at all. They're all at all-time highs. You see, and they're looking pretty overextended as well. So I don't know.
Volatility Armageddon. Is that what we're alluding to?
Yeah.
Like you think.
Well, it was liquidity Armageddon, but maybe it's the volatility Armageddon that we're really need to prepare for.
Bitcoin's move up from October to now basically front ran this move up that we've seen in equities to all-time highs, right? Like Bitcoin made its move up way, like these were all the way down here in October, and Bitcoin shot up well before them, outpaced it. And you see that it typically works on a lag. So Bitcoin will move first, then it'll sell off first in a dramatic fashion prior to equities. And now you see them all looking really overextended and Bitcoin looking weak. You see the dollar looking strong. You see legacy volatility is not priced for this at all. It's basically near all-time low levels. People are not expecting any sort of liquidity shock. So it could be we're out of our minds or the market is just wildly offsides and in the midst of euphoria right now.
Okay. I imagine we could do a lot more discussion on this, but just in the interest of time for what we have left on the show, I want to transition to the final part where we typically talk about some trades. And I want to position it more around how people might position themselves with the expectation that this is going to happen, that there's going to be a liquidity Armageddon event. So first thing, JJ, I do want to go over your Degen call, see how it's performing, looking at the coin call interface, this super elegant coin call interface. And then I just want to wrap it up with a question of how do you think people could be best positioned for liquidity shock? Where do you think they would have those assets? JJ, let's start with that. How is that Degen call that you talked about, I think the last couple of shows, how's that working out right now?
What was the one we pointed out last week? I believe it was the 41,000 call.
I believe so.
For February. It got the nice spike up. So if you would have sold that on the spike up to 40,500 or so a couple days ago, you'd have made some nice money. These are still valid. Like I think if you're playing for that short-term bounce back to the yearly open level, these could still get you some nice gains. Longer term, if you're looking for options here, I still think the February 22nd strikes are a good idea here because IV is so low. Like you're not paying a huge amount of premium. So say we do fall to this 200-day moving average over the course of the next month, get a long liquidation wick down. You can buy options that would, even if you're holding spot and you just want to hedge yourself a bit, you could buy these 3,500 options for 420, all the way down to 3,200 for just 178. So these could really multiply. Like if we move down to 28,000 before the end of February, these are worth 4,000 a piece and you're only paying 178. So from a risk reward perspective, that's a good play. If you wanted to play the bounce, I still think anything this February 1st, like we look at February 8 calls. Let's see here. So I think like anything here, like 4,100 and above, if you wanted to have short position, then offset it with a little bit of a hedge in case we do get a spike up. I think these are good ideas to offset it. I wouldn't necessarily play these directionally alone. Like I think this is probably too much risk premium here if you're not hedged to just buy into those because the upside IV for whatever reason is still elevated, as where the downside IV, you're really not paying a ton of premium for the potential downside that we would face if there is some kind of liquidity event coming in the next month or so.
Okay. Well, so far this has been in the black since you talked about this trade a couple of episodes ago. For those who are asking questions about all the terminology that JJ just mentioned, he does have, of course, it's a playlist that we have on the channel. He's continued to add to it. He's got more content that's going to be coming out about how to trade options in the crypto markets. So definitely you're going to want to check that out. But let's transition to this last question, which I had was, let's assume we've got this liquidity event coming. How do you think someone prepares for that, right? Knowing that we're expecting a liquidity shock, you know, Ben, you just talked about the fact this could actually create that liquidity event for Bitcoin to finally drop below. In that case, I imagine a lot of people will say, hey, I want to be able to be in cash, perhaps stable coins. Is there anything else you think people are going to be well positioned in if they're anticipating this event to happen?
I would say just look at L1s that ran hot for the past 6 months. I mean, on my screen right now, I think I got AVAX here alongside Bitcoin. It's in Solana right now. I'm trying to change it to AVAX, and it doesn't. There we go.
There we go.
And you could see this gap right here. Like, this is beta. You know, people don't always know what that term means. It's basically the difference between two assets on a move. As Bitcoin goes down and AVAX goes down further, that represents sort of the beta that you want to capture. And I believe CoinCall has options contracts on altcoins. I don't know if they have one explicitly on this token, but you know, finding those tokens that essentially liquidity would get sucked out of in any sort of rush to liquidity, that's good opportunity right there. And you don't have to go ahead and necessarily sell, and because we always talk about, you don't want to be fully out of your position this early in a bull market. You don't want to fall victim to FOMO if everything starts running and going against your thesis.
Right.
That's
you also need some exposure just to feel the market. That's a powerful thing. Like if you're exposed to it and you feel it going down, like, you know, when you feel like selling, and that's almost a good time to buy. It gives you a better sense of the market, even if you're sitting on some losses for a short time period. So I'd recommend always having some kind of spot exposure for that purpose alone, so it doesn't distort your view.
Yeah, that's a great point. Yeah, so if I were to kind of synthesize what I was alluding to, just find layer ones that were running really hot at the end of the year and feel like they're overextended, and try to find some downside exposure and use it as a hedge. I think a month ago, you know, almost right after the ETF, I would say, we started begin having some hedging in your portfolio so that you can go ahead and capture some of that downside without necessarily needing to just, you know, it's not always like buy spot, sell spot, go long, go short. It's never, you know, that sort of binary decision when it comes to being in the market. You can always kind of express some of your thesis differently. And I think options, you can actually hold a long-term thesis alongside a very short-term thesis. And, you know, then we get into the lumpy discussions, which I'll try to avoid.
So this could be, just to kind of put a cap on that, it could be buying some puts, right? And then, unless I'm misunderstanding what you're saying, it's buying some puts on CoinCall. Could be an option to get some of the down.
They're extremely
and if your timeline is that March range for when a downside event could be taking place, you want your horizon to be a little bit longer, right? If you're looking at March, you know, you kind of want end of April, end of May, perhaps even June. That might be a little too much, but that tends to be a more liquid contract. When it comes to all contracts, I can't imagine there's that much liquidity. So you might have to be, so let me actually take all that back, right? Because if you have low liquidity on options contracts, you're probably going to have to hold it to expiration. So you want to be comfortable with that time horizon on that downside exposure.
Okay, so that's one way you can position yourself. JJ, what's your perspective, knowing that, you know, if you're anticipating this liquidity Armageddon event, what are you doing? How are you positioned for it?
Beautiful thing is that we have some kind of fractal to compare this to, right? So say we do get an Armageddon, we already have that fractal from March 2020. So you see it fell down below the 200-day moving average and retested the lower Bollinger Band on the weekly chart. Similar move were to happen, this is your buy zone. So anywhere between 33,000 and 24,000 roughly, that's where you'd want to be buying spot big time, this whole zone here. So I'd say have some dry powder on the sidelines and wait for this real capitulation move, because over the course of the next 18 months, you buy here, you're probably going to be in extremely good shape. In terms of hedging, like we pointed out, the puts, There's always those put options. They're probably as cheap as they're going to be for quite a long time over the next couple of weeks. Maybe the IV train continues for a month or so, but I don't think it's got a whole lot of life left in the short volatility trade. I think that's nearing its end. If you're looking at equities and whatnot, like we were saying, nobody's in a rush for protection right now, and I don't really understand it. You see how overextended things like the SPX and NASDAQ look at these points, like look at these RSI levels on the weekly. They're in extremely overbought territory, right? That doesn't mean it's going to top tomorrow, but over the course of the next couple months, that seemed likely. The volatility levels are extremely low. So you could buy out of the money puts or long volatility calls here for very low premium. And I think that's a good risk reward so long as Dixie is churning hot above 103.
Okay. So I think there you have it, guys. There's a couple different ways you could be playing this potential liquidity event. I suggest you check in with us every single Tuesday and Thursday because we're going to continue to monitor the situation, check in on the language that's coming out of the Fed and seeing if we're starting to see some of those signals coming in to us that would suggest that this Armageddon is actually going to happen, because that would be very interesting timing, and it could have a huge impact on this market and also be probably one of the best buying opportunities you have found. All right, let's wrap this one up. JJ, Ben Lilly, I want to say I appreciate you guys coming through and dropping all this alpha. For all those out there that are wondering where the market's going to go, how much you can rely on this information, you know what? We're just trying to paint the best picture we can of the market. If you have ideas of something we're missing, we'd love to hear it. Drop it in the comments. Let us know something that we need to analyze. We're always looking for some input for you guys. We're doing this show for you. And with that, I will give my PSA every show, which is to have some dry powder, be prepared. This is Marconi White signing off.